Hey everyone, I'm Jeremy Szafron, and this is Kitco News. Now, lots to discuss on Chart This with Gary Wagner this week. Recently, gold reached an all-time high. All of this, of course, as we wait to hear from the Fed about interest rate cuts. Now, the market's slowly getting more comfortable here, pricing in 3, possibly 2 cuts by the end of the year. And Bitcoin, too, surging to an all-time high. Of course, we've seen a bit of a correction. We'll talk to Gary about the chart and what he's seeing during this small pullback, as it seems investors are rebalancing portfolios and possibly taking a little bit of profit here. And you may have heard silver in the headlines because it's holding up to a 4-year resistance level. And then finally, we'll chat about copper. We've seen some breakout moves on that metal. And of course, Gary Wagner joining us from Hawaii to break it all down. Gary, thanks for joining us.
Thanks for having me. Great to be here.
Always a pleasure. Now, we haven't chatted in about a couple of weeks, and since then, we've seen some all-time highs in quite a few different areas. Let's start with gold, though. Of course, catch us up on what we're seeing here. We saw the all-time high. What's the chart saying? Gold making history once again.
All right. Well, I'm pulling up it's called an intraday chart. I typically use dailies, but each candlestick here represents 4 hours of trading, and it's divided, obviously, into a 24-hour period. And the reason for that is you can't see it in the daily, but in the 4-hour, we have what's called a bull flag. You've got your flagpole here, the straight line up, and then you use 2 parallel lines. The idea is that it zigs from the top, from the highs to the lows, highs to the lows, and it breaks to the upside when it's in this formation. Now, whether or not it pans out like that will depend on the fundamentals that move the market, but it's a very interesting pattern to look at. And if that's the case, it's signaling that after this move down, because history was made a couple of weeks ago, we broke $2,200 per ounce, $2,300 per ounce. I would never thought we would see that this early in the year. And 10 years ago, if you had asked me, I would probably say we'll never see that. But nonetheless, we're there. We've softened a bit. And depending on what happens over the next day or so, will determine whether or not we see gold really reignite, move to the upside, or continue to move lower, because it is going to hinge on the Federal Reserve.
Right. You know, it's interesting. You know, it seems like it's forming a new base here at that 2150 level. Break that down a little bit. Obviously, gold always gets jittery around economic data. Even if the Fed surprises us somehow, are these prices a new normal for gold?
They are. They are. I think that what we're seeing is the fact that gold has always been a hedge against inflation. And the way that you want to look at it is buying power. Inflation really means what your dollar can buy you, or your yen, or whatever currency you're looking at. And if you consider the buying power of gold 10 years ago, or 20 years, or 100 years ago, and the buying power now, you can pretty much buy the same thing for the same amount of gold. But the currencies have devalued tremendously ever since we went to a fiat currency system worldwide.
Right. Well, I mean, you talked about this bull flag. I'm curious, just break this down for the audience a little bit about your price forecasting here in the short term. Where do you think that gold is going to be going?
Well, we have really strong, what I'm calling support near the lows that we had just recently, which is right around 2150. And the reason I pegged that, now for this chart, I'm going to have to really go ahead and compress it to get to that area. Yeah, if you bear with me, that's this rectangle here. If you recall, we had an interesting leg up to where we are now, in which on Friday, it went to an all-time new price high, and then it spiked up. This right here represents 2152. And by Monday morning, close of New York Monday, excuse me, it was way back down. And when I say way back down, it was down to about 2090. So this to me is what I've been labeling as a key level of support, just because the way a market technician looks at support and resistance is tops and bottoms, also Fibonacci retracement, but tops and bottoms are very accurate ways of determining support and resistance. The other thing that's good to know if you're learning about technical analysis is that support and resistance are part and parcel of the same thing, meaning that an area can be resistance, meaning as the market goes up, it hits it, it's going to come down. But if it breaks through, it then becomes the floor or support. So the same price point can act as support or resistance.
Right. Interesting. Okay, so then let's take it to the flip side. Talk about silver. Obviously, we got an interesting gold-silver ratio. It's been on a little bit of a rally lately, and it seems to be holding up. Let's bring up the chart. What are you seeing? Is there any resistance levels here? Is this a sustainable climb on this price?
Well, right now we've had 2 days of sell-offs. I personally think that major support comes in at around $25. I'm looking at June futures currently at, say, $25.33. And so if it doesn't hold $25, it could slip lower. But I'm looking for it to actually challenge this recent, these are what's called a real body. The wick is the difference between the relationship of the open and close, which is how you create something in a candlestick. And this is the actual high that we had back in December of last year. So I think in terms of room to grow, it could easily move to higher areas, 26 and beyond, if the trend continues. If not, support at 24.25.
Interesting. Anything worth mentioning on those two comparisons, the gold and silver ratio? It seems to be quite divergent.
Well, the biggest thing that I've noticed over a medium to long-term period of time is a decoupling of the tandem nature that, as I grew into being a trader, was there. In other words, gold moved up, silver moved up. Gold moved down, silver moved down. The key difference was during a rally, silver would outperform gold in terms of percentage gains. The same with a correction. When they were both going down, silver would overperform or have a larger percentage drawdown. But they moved in tandem. That has, I call it a decoupling, because there are now days where I will see silver trade higher and gold lower, or vice versa. And that's something that we didn't see, say, 5 years ago or 10 years ago.
Yeah, interesting perspective there. Let's switch over to Bitcoin. I mean, it's been quite the ride. Of course, we mentioned all-time highs off the top. We saw an all-time high on the Bitcoin side too. Gary, bring up the chart. It seems some investors are taking some profit here, possibly rebalancing their portfolios. What are you seeing? And I'm curious about your forecast in the short term.
Well, absolutely. I mean, it hit a high on this just above $73,000 per coin. This is a Fibonacci retracement drawn off of an extension, but these are different levels that we would look at. And the reason that we'll go to this technique of trying to predict where a correction might find support is when you're at all-time or new record highs, there isn't anything historically to compare it to. So what we do is we look at a sequence of numbers. So what I'm looking at now is it ran from this rally down here in 2024. It corrected down to these lows that came in around 38. And then the rally was a 1.38 extension. So right now it broke through the one, and that's a 1-to-1 from one rally to the next is all it's representing. If it continues to break, the next support level would be 59,700 to 60,000. That's what I would look for. Long term, I am bullish. The question is, obviously, when something goes up that fast, that high, people are going to take profits, and that's why we're seeing a correction. Do I think that the rally in Bitcoin is over? Not by a long shot. The question is, where will the correction conclude?
Yeah, no, it's a huge question indeed. And so what you're showing from the patterns emerging from the chart here is around $59,000, $60,000 mark. Maybe we can see a little bit of momentum there. I mean, we got halving coming, of course, in April as well. And in history, this usually sends the price up.
Correct. It does. But also, prior to the halving, it typically corrects.
Right.
So you're right. It does go up after the halving, but in In other instances, it actually had corrected up to the halving and then moved back higher. But you are correct. You would look for whatever price Bitcoin is at when the halving actually occurs and expect some sort of a rally from there.
Right. Okay. Well, let's turn over to copper. I mean, it's always an interesting space. There's been some talk about smelter cuts in China in terms of output, maybe seeing a price in jumps. I mean, we saw 11-month high in the copper price. Let's talk about the breakout. Where do we go from here? Is this a sustainable, is this a sustainable run on copper? I mean, it seems like it's not going anywhere. People need copper.
Well, I would have to say it's gone quite far. When you consider in February, it was trading at around $700 per pound. Copper is sold in pounds in terms of the contracts. It then went to a high of 768. But look at the move today, a tremendous move from opening above 764 to its current pricing, which is about 756. So it's declined by about $8 per pound today.
Is this just a correction?
It could signal a correction. It's either going to be, technicians are funny in that we have an answer on both sides. It's not that we're trying to balance our bets, although what we are trying to do is anticipate either way it could move. This could be what we call a one-off or a one and done. That does happen if there's a true demand supply imbalance. Then it quickly corrects itself if what's happening is the demand is exceeding the supply. Then even if it sells off, it will quickly move back to the upside. Right now, support 754, it's just above there. If it corrects, it could go to 745 per pound. And these are just the numbers that I'm working off of, which is the 23.6% Fib retracement and the 38.2.
Right. Yeah, no, it's fascinating. And it seems like the demand is diminishing while the supply, the demand is not diminishing while the supply is. So we'll be keeping an eye on that. Talk to me a little bit about oil, interesting side here. It's been up. Let's not forget that energy prices have been pushing CPI up in the U.S., Gary. So what are the technical indicators currently signaling here when you bring up an oil chart?
Well, what I want to really look at is that oil is such a large component of what makes up inflation, because regardless of what industry you're in, with the exception of digital to some degree, if you're moving a product from point A to point B, it's going by rail or truck or airplane. In any case, for the most part, more oil is used. And if you look at the beginning of the year, and oil was trading at about $70 per barrel, right now it topped above 82 per barrel. And so that's a tremendous move. So, for example, when we looked at the last inflationary numbers that showed an uptick in inflation, a large percentage of that change, that uptick, was directly related to gasoline, which is a derivative of oil, which we call the energy composite of it. So when oil moves higher, it's going to affect inflation by also taking it higher. And that's why it's so important to look at the price of oil per barrel.
Right. Yeah. I mean, the commodity seems to be quite hot here. Of course, we're waiting to hear from the Fed. We'll wait to hear more on that. Could this be just a commodities run? I mean, it seems quite cyclical in that it's happening all around us.
Well, it's always a commodity run is still going to have a fundamental basis. It doesn't run to run. It runs because there's an imbalance between supply and demand. For example, with energy in the United States or in Canada, we tend to use a lot more of it during the summertime. Families travel and drive. So you do get a seasonal thing. Then you have geopolitics entering into it, whereas a lot of oil is derived from the Middle East, and the Middle East puts it through the Red Sea. And of course, now there are some shipping issues down in Yemen. So that will affect the price of oil. So it's how easy is it to get from point A to point B, how much they're producing, and that remains more constant than anything else. It's the demand that wavers up and down more than the supply.
Yeah, absolutely. I mean, oil is always a fascinating one, obviously, with the geopolitical situations happening too. When you looked at that chart, do you see any resistance levels here? Is this a good trade, Gary?
Well, in terms of resistance, we've got to go just a little bit back. And so I've compressed it. The last high, and this occurred in October of 2000 and September 2023, it was at 92. And then if we look at this top here, October 20th, 23, and that's coming in at 88. So if we go to where it currently is, I'm just moving my cursor, and then we go across to these areas. This is not what I would call a top. This is obviously a top. And so we look at these points, it's above this lower bottom. In other words, what you see I am doing is simply comparing current pricing to areas that has been before. So this is our current price. And when we look at that, it could have room to grow. I mean, resistance comes in at 85, then comes in again at 88. So all things being equal, the charts don't lead the price, fundamentals do. And what's good about technical indicators is, and it's why I became a market technician, is that fundamentals can be spun in terms of the way we describe what's happening. And I had a mentor, his name was Larry Williams. I'll try to do this story quick. And he said, as a technical analyst, you're a guy sitting at the end of a ship. You're looking at the waves created or the wake created by the propeller and trying to anticipate when the ship's going to turn. And then he looked at me, he said, but only the captain knows when he's going to turn the wheel. In other words, technicals have to, by nature, lag behind the fundamental events. And it's simply a way to mark those changes. So when I say that there is resistance at this point, it's still going to depend on supply and demand and the particulars of that stock or commodity, in this case, all commodities. But the fundamental event is going to lead the way, not the chart.
Yeah, I mean, fascinating. Never a dull moment in the market. Lots going on here. Gary Wagner joining us from Hawaii. Thank you for getting up this morning, sir. I appreciate your time as always, and we'll see you next week.
My pleasure. See you next week.
Thanks, Gary. And thanks again, of course, to our viewers for tuning in today. Don't forget to subscribe to our YouTube channel and click that little like button. Believe it or not, I do read the comments, so come and say hi. I'm Jeremy Szafron. We'll see you next time.